Imagine bringing home like a straight A report card. You put it proudly right on the fridge for everyone to see.
Oh, yeah. Standard procedure.
Right. But then you turn around and you have to confess to your parents that you also completely totaled the family car on the way home.
Wow. Yeah, that's a tough conversation.
It really is. And if you are trying to make sense of Wall Street right now, that is exactly what Air Products and Chemicals just did to the market.
Yeah, ticker symbol APD for those of you tracking it at home.
Exactly. Welcome to this deep dive, everyone. We are looking at a financial landscape today that forces this, just a massive contradiction right out into the open.
It really is a wild earnings print to break down.
It is, because you look at the headline revenue, right?
Yeah.
You look at the profit, and it tells a story of aggressive, efficient growth. But then, lurking right there in the background of this exact same quarterly earnings report is a staggering, mind-bending $2.9 billion pre-tax charge.
$2.9 billion with a B.
With a B. So our mission today on this Talk Tickers Deep Dive is to sort the signal from the noise. We are using the exact Q3 2026 earnings transcript featuring CEO Eduardo Menezes and CFO Melissa Schaefer.
And, the tension in this specific transcript is just palpable.
Oh, totally.
When you read through it, you are watching a management team execute a massive structural pivot in real time. If you just scan the bold print of the press release.
Which is what a lot of people do. So.
Right, exactly. If you do that, you see a classic beat and raise quarter. Everything looks structurally sound. But that almost $3 billion charge, that's the sound of a company completely abandoning a massive strategic vision.
Yeah, they just, they hit the brakes hard.
They really did.
Yeah.
So to understand what is actually happening with this stock, we have to tear apart the mechanics. We need to figure out how a company can bleed billions of dollars on one side of the ledger while simultaneously generating record-breaking profits on the other.
Right. So let's get straight into section 1 of our framework, which is the headline numbers. Because the top-line data management dropped at the very beginning of the call is honestly fascinating.
It is. The core engine is humming.
Yeah. We are looking at Q3 adjusted earnings per share, or EPS, hitting 3.47 cents. In dollar terms, that's a 38-cent increase, or 12% growth year over year.
Which is solid, very solid.
But here's the piece that required some translation. That $3.47 didn't just grow from last year. It actually beat management's own guidance range for the quarter.
And see, that guidance beat is a critical signal about their core operational engine.
Oh, so.
Well, when a management team tells the market, we expect to make between X and Y, and then they deliver a number above Y, it indicates that their internal forecasting models were actually too conservative.
Ah, okay. Like they underestimated their own efficiency.
Precisely. And we see that efficiency reflected directly in the sales and income relationship. So sales grew by 5%, right?
Okay, 5%.
But operating income jumped by 9%.
Oh, wait. I want to pause on that relationship for a second. If operating income is growing nearly twice as fast as overall sales, that implies the business is extracting more profit out of every single incremental dollar that comes through the door.
Exactly. That is the textbook definition of operating leverage. They aren't just pushing more volume, they are operating with a significantly lower cost per unit.
Right, which goes straight to the bottom line.
Exactly. And this is immediately visible in their operating margin, which expanded by over 100 basis points.
Okay, for those of you listening who don't spend all day staring at Bloomberg terminals, let's just define basis points real quick. 100 basis points is exactly 1 percentage point.
Right, good clarification.
So their operating margin landed at 25.6%, which means over a quarter of every single dollar they generate in revenue is turning into pure operating income.
Which is huge, yeah.
For a heavy, capital-intensive industrial business that literally builds massive metal plants and pipelines, keeping 25 cents on the dollar is, it's a massive feat.
It really is a remarkable margin for this sector. Sure. It ties directly into another vital metric they reported, which is return on capital, or ROC.
Okay, what was that number?
It sat at 11.7%. And this metric improved by 60 basis points from the prior year, and it even improved sequentially from the last quarter.
Okay, I'm going to push back on that 11.7% figure for a second.
Sure, go ahead.
Because if you look at, say, massive tech companies or software as a service businesses, you routinely see returns on capital in the 20s or even 30s.
Oh, absolutely.
So why should an investor be excited about an 11.7% return?
Well, because comparing a software company to an industrial gas behemoth it's like comparing an app developer to a steel mill.
Right, apples and oranges.
Exactly. Software companies write code once and sell it infinitely. Their capital intensity is incredibly low. But Air Products operates in the physical world.
Very physical, heavy metal.
Right. They build multi-billion-dollar industrial gas plants. They lay miles of specialized pipelines. They purchase fleets of cryogenic transport trucks.
It takes a lot of cash just to turn the lights on.
Exactly. Their business requires sinking billions of dollars of cold, hard cash into the ground before a single cent of revenue is generated.
Okay, so the denominator in that return calculation is just massive.
Huge. So when we talk about return on capital in this context, we are measuring the raw efficiency of that heavy physical infrastructure. An 11.7% ROC means that for every single dollar they have historically invested into their global network of steel and pipes, they're generating nearly 12 cents of profit back.
Every single year.
Every single year. For a heavy industrial company, anything consistently in the double digits is the hallmark of a highly disciplined cash-generating machine.
Okay, so that paints a picture of a phenomenal underlying core performance. Sales are up, margins are expanding, EPS is beating guidance.
Yep, the engine is running perfectly.
That is the straight A report card. But I want to talk about the totaled family car now.
Let's do it, the elephant in the room.
Because the adjusted EPS looks great, but GAAP accounting, generally accepted accounting principles, tells a completely different story here.
A very painful story.
Yeah. CEO Eduardo Menezes stated point blank, as a result, we recorded a pre-tax charge of $2.9 billion this quarter.
Yeah.
So if the core business is operating at peak efficiency, what physical reality creates a $3 billion hole in the balance sheet?
To understand the physical reality, we need to look at the specific projects management named on the call.
Okay.
This $2.9 billion charge is the direct cost of canceling massive, highly ambitious clean energy projects that the company had previously committed to.
Which one specifically?
They specifically named the Louisiana project, often referred to as the Darrow project, the Casa Grande facility in Arizona, and a handful of other smaller-scale clean energy distribution networks.
Okay, let's explore the mechanism of a charge like this. Because if I am an investor and I hear my company just took a $3 billion hit.
Right, the immediate panic sets in.
Yeah, my immediate fear is that $3 billion in cash just walked out the door this quarter. Like they just wrote a check. Is that what happened?
Not exactly. And the distinction between cash flow and accounting reality is crucial here.
Break it down for us.
Think of this massive capital impairment charge, like spending 5 years building the concrete foundation for a massive skyscraper.
Okay.
And then suddenly you realize the soil beneath it is fundamentally unstable. So you make the decision to fill the hole with dirt and walk away.
Ouch.
Right. The money you spent on the concrete and the labor over the last 5 years is already gone. It was spent in the past.
It's sunk.
Exactly. But under GAAP accounting rules, you had been holding the value of that foundation on your balance sheet as an asset under the assumption that it would eventually generate revenue.
Right, because you thought it was going to be a skyscraper.
Yes. But when you cancel the project, you are forced to admit to the market that this asset is actually worth zero.
Okay, so the $2.9 billion charge isn't a new check they're writing today. It is the accounting recognition of a sunk cost. They are pulling that asset value off their books entirely.
Precisely. It is an admission of a past miscalculation forced by a changing macroeconomic reality.
So what changed? Why cancel them now?
Well, they looked at the current interest rate environment, they looked at inflation and construction costs, and they looked at the uncertainty of customer offtake agreements in the green energy space.
So the math just didn't work anymore.
The risk profile simply no longer justified the massive future capital they would still have to deploy to finish these projects. So they made the incredibly difficult, highly unpopular decision to pull the plug and clear the decks.
You know, if you are an investor, that is a deeply bitter pill to swallow. Management basically admits they allocated billions of shareholder dollars to a vision that just failed to materialize.
It hurts the credibility for sure.
But at the same time, I mean, if you're bleeding cash on a construction site that is no longer viable, severing the cord is the only rational move.
Exactly. It prevents good money from following bad money.
Right. But that forces a massive question, which leads us to section 2, the story behind the numbers. If they are in the middle of clearing away billions of dollars in canceled projects, how on earth did they actually beat EPS expectations?
Yeah, it's the ultimate paradox of this quarter.
Right. And how did they expand their operating margins in the exact same quarter? Like, What is actually funding the day-to-day cash register while the C-suite takes a chainsaw to their green energy portfolio?
Well, CFO Melissa Schaefer provided a very granular breakdown of the mechanics driving the day-to-day business.
Let's hear it.
The growth wasn't generated by financial engineering or accounting tricks. It was driven by two very tangible levers: physical volume and sheer pricing power.
Okay, let's dig into the physical volume first. If you are canceling massive future projects, where is the current physical volume growth actually coming from?
The volume improvement was heavily led by their on-site business model.
On-site, okay.
Yeah. They had new physical assets coming on stream and initiating production in Asia and the Americas. Additionally, they experienced significantly higher production output, specifically from their existing U.S. refinery assets.
The phrase on-site business is thrown around constantly in these industrial transcripts.
It is. It's their bread and butter.
Right. But if you are listening to this, you might picture a typical supplier relationship, where Air Products fills up a truck with gas and drives it to a customer's factory. But the on-site model is a completely different mechanism, isn't it?
It is entirely different. And honestly, it is the secret to their incredibly stable cash flow.
How does it work?
In the on-site model, Air Products doesn't just deliver gas. They actually finance, build, own, and operate the massive air separation unit or hydrogen plant directly on the customer's physical property.
Wait, they build the plant on the customer's land?
Yes, and in exchange for putting up the capital to build that plant, the customer signs an ironclad 15 to 20-year take-or-pay contract.
Okay, hold on. A take-or-pay contract, meaning the customer is contractually obligated to pay for a minimum volume of gas every single month for 2 decades, regardless of whether they actually use it or not.
Exactly. It effectively turns Air Products into a localized utility monopoly for that specific industrial facility.
Wow. That is an unbelievable moat.
Right. So when Schaefer notes that volume growth is coming from new on-site assets coming on stream, she means that multi-year construction projects have finally been completed, the switch has been flipped, and those 20-year guaranteed cash flow contracts have officially kicked in.
That perfectly explains the stability of the volume, but volume is only half the equation here. You mentioned pricing power as the second lever.
Yes.
And this is where the transcript gets genuinely surprising to me. Schaefer explicitly noted that pricing was up, primarily in Europe and the Americas.
Yep, they pushed prices higher.
And this pricing power was absolutely vital to overcome fixed cost inflation, distribution costs, and dislocation costs stemming from facility maintenance. But I have a major conceptual hurdle with Europe.
What's the hurdle?
The macroeconomic reality of Europe. I mean, the industrial sector in Europe is practically in a recession right now.
They're very weak, yeah.
Manufacturing output is down. Energy costs have been incredibly volatile since the invasion of Ukraine. CEO Eduardo Meneses even said on this very call that it is not a surprise to anyone that the industrial market in Europe is not growing.
True.
So if your customer base is struggling just to keep their own factory lights on, how do you possibly force a price hike down their throats?
That's a great question.
Because operating income in Europe increased by 2%.
Yeah.
A 2% currency tailwind helped, sure, but the core story was pricing. How does the mechanism of that pricing power actually work in a distressed market?
You are hitting on the most crucial protective mechanism in the industrial gas industry, the pass-through energy contract.
Pass-through. Okay, explain that.
When Air Products produces industrial gases, whether they are separating nitrogen from the atmosphere or reforming natural gas into hydrogen, the single largest input cost is raw energy. They consume massive amounts of electricity and natural gas.
So if the cost of natural gas spikes in Europe, their manufacturing costs skyrocket.
Exactly. Mm-hmm. But Air Products does not absorb that risk. Their contracts are specifically structured so that raw energy and utility costs are treated as direct pass-throughs to the end customer.
Oh, wow.
Yeah, so if the grid price of electricity doubles, the price the customer pays for the industrial gas automatically adjusts upward to cover that exact spread.
Automatically.
So Air Products is able to protect its operating margin and pass the inflationary burden directly to the customer, contractually.
I bet the customers absolutely hate that.
Oh, they probably do. The customer might hate it. They might reduce their overall volume if things get bad enough, but they cannot negotiate away the underlying cost of the energy required to make the product.
So getting a 2% operating income growth in a stagnant European market isn't a sign that they are selling more gas. It is a sign that their contract structures are successfully shielding them from a brutal inflationary environment.
Precisely. It is a defensive victory, not an offensive expansion.
That makes so much more sense.
Yeah. For the offensive expansion, we have to look at the regional data for Asia.
Right. Because Asia was the absolute standout for growth this quarter, wasn't it?
It really was. Operating income in Asia was up a massive 18%.
18% operating income growth for a company of this scale is staggering. What were the specific mechanical drivers in Asia?
It was a confluence of three distinct factors. First, they saw significant benefits from gasification assets that are currently categorized as held for sale.
Okay.
Second, they had those new on-site assets we just discussed finally coming on stream. And third, they experienced an unexpected benefit from helium.
Oh, I definitely want to unpack the helium situation because that is a wild narrative all on its own.
It's fascinating.
But before we get there, let's clarify gasification assets. What exactly is gasification and why is it driving growth?
Gasification is an incredibly complex chemical process. Essentially, you take low-value, carbon-heavy, solid feedstocks like coal, petroleum coke, or even certain types of biomass.
Stuff you would normally just burn.
Right. But instead of just burning the material, you subject them to intense heat and pressure in a highly controlled environment with oxygen and steam. This process breaks the molecular bonds and converts the solid fuel into a synthetic gas, commonly called syngas.
And syngas is primarily a mixture of carbon monoxide and hydrogen, correct?
Yes. And syngas is incredibly valuable in regions like Asia, specifically China, where they have abundant coal reserves but lack cheap natural gas.
Ah, I see.
The syngas can be used to produce high-value chemicals, fertilizers, or even generate electricity. So these gasification facilities are highly profitable, complex assets driving that 18% regional growth.
Okay, that covers Asia. And shifting from Asia to the Americas, we saw operating income up 6%. Management noted this was driven by volume from their Haichio facilities and a new asset on their Gulf Coast hydrogen pipeline.
Yeah, HCO is simply the industry shorthand for hydrogen and carbon monoxide.
It's the two gases together.
Exactly. These are the critical gases used by massive oil refineries to remove sulfur from transportation fuels, and by petrochemical plants to synthesize plastics and other complex materials.
Got it.
The Americas' growth is a testament to the heavy industrial base in the U.S. continuing to demand high volumes of these base gases. However, it is worth noting that they did face some headwinds in the Americas from fixed cost inflation and maintenance dislocation costs.
Okay, let's jump over to the Middle East and India segment, because this region threw out a number that requires immediate clarification for anyone looking at the numbers.
Yeah, it was a weird one.
The core operating income for this segment was essentially flat, but their equity affiliate income jumped by over $100 million in a single quarter.
A huge spike.
Right. If you are an investor looking at a spreadsheet, a sudden $100 million spike in a secondary line item makes you question the integrity of the trend. What is the mechanism behind equity affiliate income, and how does it jump that drastically?
It is a vital question for anyone trying to model the future cash flows of this company.
Right.
Equity affiliate income is an accounting mechanism used when Air Products owns a significant stake in a joint venture, usually between 20 and 50%. But they do not have total controlling interest.
So they don't own the whole thing.
Right. Because they don't have total control, they cannot consolidate the joint venture's total revenue onto their own top-line sales. Instead, they simply record their proportional share of the joint venture's net profit on a single line item below the operating income line.
So Air Products is a partner in a massive business in the Middle East, and that business suddenly paid out a massive profit share.
Exactly. And during the Q&A portion of the call, Jeff Zekauskas, an analyst from J.P. Morgan, zeroed in on this exact anomaly.
The sharp analyst.
Very.
Right.
He asked management point blank if these joint ventures have permanently leveled up to a new baseline of profitability, or if this $100 million spike was a transitory one-off event.
Which is the crucial question. Because if it's a permanent step up, you bake that into your valuation model and the stock looks incredibly cheap.
Right.
But if it's a one-off, you have to back it out. What was management's answer?
CFO Melissa Schaefer was very transparent. She clarified that the spike was largely contractual and structural, driven entirely by the timing of a preferred dividend paid out to their joint venture partners in Saudi Arabia.
Ah, so it is essentially an accounting timing quirk based on when a massive check was legally required to be cashed.
Precisely. She explicitly warned the analysts not to extrapolate that number forward. She stated that this specific massive jump is not the new normal, and they expect the normal run rate to reconfigure and normalize in the fourth quarter.
So, as an investor, you are thrilled to see the cash hit the balance sheet today, but you absolutely cannot model that $100 million jump into your projections for next year.
You really can't.
And honestly, that is the exact reason why skimming a press release is dangerous. You have to read the transcripts to separate recurring operational momentum from one-time accounting quirks.
That's why we do this.
Exactly. Okay, I want to pivot to a commodity that completely fascinated me in this transcript. Helium.
Oh, the helium market is wild right now.
It really is. Management had previously guided the market that helium was going to be a severe drag on the quarter, projecting a 3% headwind to their earnings. But the final result came in significantly better than expected, only hitting them for a 2% headwind.
Right. And to put a concrete dollar figure on that percentage, one of the analysts estimated the actual penalty was maybe a bit over $100 million pre-tax, rather than the $150 million initially feared by the market.
Now, if you are listening to this and you aren't deeply embedded in the industrial gas sector, your primary association with helium is probably party balloons or making your voice sound funny.
Yeah, that's what everyone thinks of.
But in the context of global heavy industry, the helium market is highly complex, incredibly volatile, and structurally unforgiving.
It is a brutal market.
The way I interpret Air Products' position in the helium market is that they are essentially playing a massive, high-stakes middleman game. They don't necessarily pull all of this gas out of the ground themselves as a primary driller. They are positioned in the middle of a sprawling global supply chain.
Right. They source it and distribute it.
And the fundamental law of being a middleman is that you are constantly at risk of being squeezed from both sides. You get squeezed by the primary drillers when the raw supply is short, and you get squeezed by your end buyers when the market is flooded with long supply.
Your interpretation is entirely accurate. In fact, CEO Eduardo Menezes even utilized the term middleman himself during the call to describe their historical position.
No, he did.
Yeah. And to understand why the market is so chaotic right now, you have a look at the structural shift caused by the end of the Federal Helium Reserve, known as the BLM.
The Bureau of Land Management Reserve in Texas. For decades, the U.S. government basically subsidized the global helium market by hoarding a massive strategic supply and selling it off at predictable intervals.
Exactly. When the government mandated the privatization and sell-off of that reserve, it fundamentally removed the stabilizing anchor from the global market.
Wow.
Suddenly, companies like Air Products were forced to become entirely reliant on a highly decentralized global supply chain spanning multiple geopolitical flashpoints.
And right now, that global supply chain is a logistical nightmare. During the Q&A, an analyst specifically pressed management about the geopolitical situation in Qatar and the ongoing shipping disruptions in the Red Sea.
Yes. And Menezes offered a very candid assessment. He noted that while they have actively diversified their raw sourcing to include the U.S., Qatar, and Algeria, the physical volumes trying to make it out of the Middle East right now are, in his exact words, very dimpled.
Dimpled? That's a polite way of saying it's a mess.
It really is, because commercial shipping is largely avoiding the Red Sea due to security risks. The logistical pathways have become chaotic. Menezes stated that Air Products is literally not even counting on Qatari helium in their current internal forecasts because the delivery reliability is completely shattered.
Okay, but this is the crux of the paradox. If one of the major global sources of helium is virtually shut off to them due to a geopolitical crisis, and they are essentially a middleman exposed to supply shocks, how on earth did they actually beat their own helium headwind expectations this quarter?
Right.
Like, what prevented their margins from getting completely crushed by spot market price spikes?
The answer lies in a single massive strategic asset. And it's perhaps the most fascinating mechanical detail of the entire earnings call. The reason they survived the supply shock is their proprietary storage cavern in Texas.
When you say cavern, you don't mean like a massive steel tank sitting in a field. You mean a literal underground geological formation.
A literal massive underground salt dome.
That is wild.
And Menezes dropped a statistic on the call that highlights just how vital this asset is. 40% of all the helium volume Air Products sold globally during this entire quarter physically came out of that single Texas cavern.
40%. That is an unbelievable concentration of volume.
It saved their quarter.
If you were listening, you might be wondering why they use a salt dome instead of just building massive pressurized tanks like they do for other gases. The mechanism here is based on the physics of the helium atom itself. Helium is the second smallest element in the universe.
It is incredibly tiny.
It is incredibly elusive. If you try to store massive commercial quantities of helium in standard pressurized steel tanks, the atoms will literally permeate through the microscopic pores of the metal over time. It leaks.
Right, it just escapes.
But geological salt dome formations are incredibly dense and structurally impermeable. You can pump millions of cubic feet of helium into a hollowed-out salt cavern, pressurize it, and it will stay there safely for years without leaking into the surrounding rock.
It's nature's perfect storage tank.
Yeah.
And that geological impermeability allows Air Products to operate this cavern as a massive strategic reserve.
Right.
And possessing that reserve fundamentally alters their negotiating leverage in that middleman squeeze we discussed. When global supply chains break down and primary suppliers try to aggressively hike prices on the spot market, Air Products isn't forced to pay extortionate rates to fulfill their customer contracts.
They just say no.
Exactly. They can simply decline the spot market price, open the valve on the Texas cavern, and draw down their own strategic reserves.
And the ability to guarantee supply, regardless of what is happening in the Red Sea, is the ultimate competitive advantage for their specific customer base. Because the customers driving the massive volume growth aren't party supply stores.
Not at all.
They are running critical MRI machines in the healthcare sector, which require liquid helium to keep the superconducting magnets near absolute zero. And even more crucially, they are the massive semiconductor foundries in Asia.
And those semiconductor fabs operate on an entirely different level of precision. A multi-billion-dollar chip manufacturing facility cannot tolerate a supply interruption.
Yeah, they can't just pause for a week.
No. If they lose helium pressure, the manufacturing line stops, and they lose millions of dollars in ruined silicon wafers almost instantly.
Wow.
So Menez pointed out that because Air Products proved to the market that they can supply their customers seamlessly supplying 40% of their volume from a cavern in Texas, while the Red Sea logistics completely collapsed, they're actively winning a significant number of new long-term contractual commitments for helium volumes, specifically in a high-margin electronics area in Asia.
They took a massive geopolitical supply chain crisis, absorbed the blow using a geological salt dome, and then weaponized their reliability to steal long-term market share from their competitors.
It really is a masterclass in operational leverage.
It is. And speaking of operations, there was one more vital detail on the cost side before we transition to their forward-looking guidance. Amidst all this global complexity, they are still aggressively trimming corporate fat.
Yes. CFO Melissa Schaefer noted that the corporate and other segment recognized significant productivity improvements by actively reducing their SG&A selling, general, and administrative expenses.
Basically overhead.
Right. They are executing a targeted headcount reduction plan, and she confirmed they remain completely on track, having already recognized approximately $75 million in corporate overhead savings year to date.
So if we synthesize the operational story behind the third quarter numbers, they are shielding their margins in Europe with pass-through contracts. They are dominating the Asian growth market with complex gasification and on-site assets. They are utilizing a salt cavern to navigate a global helium crisis. And they are stripping $75 million out of their corporate overhead.
That's the quarter in a nutshell.
That explains the current quarter. But if you are an investor, you aren't buying the stock for what they did yesterday. You are buying the stock for what management believes they can do tomorrow. So let's look at section 3, management guidance. Where is this leadership team steering this massive industrial ship now that they've cut the nearly $3 billion dead weight of those green energy projects?
This brings us to the raise portion of the beat and raise narrative. Their near-term forecast is highly confident. For the fourth quarter, management expects EPS to land between $3.55 and $3.65.
Okay, so quarter-over-quarter growth.
Yes. If achieved, that represents a 5 to 8% increase from the prior year.
And what does that mean for the full year picture?
They officially raised the full year 2026 guidance to a range of $13.39 to $13.49.
Got it.
To put that in context, that correlates to an 11 to 12% total earnings growth for the fiscal year. And this is a progressive improvement. Remember, they started the fiscal year only expecting about 9% growth. So they are steadily, methodically marching that expectation upward quarter by quarter based entirely on this volume and pricing momentum.
But here's the dynamic that investors really need to internalize. At the exact same time they are raising their future profit expectations, they are aggressively slashing their capital spending.
A massive cut.
They announce a $500 million cut to their capital expenditures, bringing the total expected CapEx for the fiscal year down to $3.5 billion.
And if you want to understand the overarching narrative of this earnings call, you have to look at the intersection of that CapEx cut and the $2.9 billion write-off.
How do they connect?
Well, Air Products is aggressively, intentionally retreating from incredibly expensive, highly uncertain, mega green energy distribution projects. They're taking all that capital that was earmarked for risky hydrogen networks, and they're systematically redirecting it back into what they've been doing best for decades: traditional industrial gases.
They are going back to their roots.
Exactly.
Menezes noted they currently have a $3 billion backlog of traditional industrial gas projects. And he clearly stated their target is to deploy approximately $1.5 billion per year in CapEx, specifically toward these traditional projects moving forward. But traditional industrial gas is a broad category. Where exactly is that $1.5 billion a year going?
It is incredibly concentrated. Over 2/3 of their current opportunity list, the projects they are actively bidding on and designing, is situated in one hyper-specific sector: the electronics and semiconductor space.
This is their play on the electronics supercycle.
Hugh.
If you listen to financial media, you hear constant coverage of the AI boom and the massive multinational push to expand semiconductor manufacturing capacity globally. Every major country wants their own chip fabrication plants for national security reasons.
Right, the Chief Act, all of that.
Exactly. Air Products is essentially positioning themselves to sell the high-tech picks and shovels for this silicon gold rush.
And their win rate in this sector is currently phenomenal. The CEO stated they have secured over $1.5 billion in new electronics project commitments in just the last 6 months alone.
Wow, in 6 months.
Yes. This backlog includes a massive multi-phase, multi-year project in Taiwan where they are constructing more than 5 large air separation plants simultaneously alongside another major facility commitment in Korea.
If you're listening, you might wonder why a single semiconductor plant needs 5 massive air separation plants.
That sounds like overkill.
Right. It does. But the mechanism of manufacturing a microchip requires an environment utterly devoid of atmospheric contamination. The foundries require staggering volumes of ultra-high purity nitrogen to purge the manufacturing chambers, preventing oxygen from reacting with the silicon wafers.
Exactly. They also require argon for precise etching processes. Without industrial gas, the entire multi-billion-dollar semiconductor industry just grinds to a halt.
It's the lifeblood of the fab.
It is. And Menezes was remarkably candid about why they are pivoting so hard into electronics. He explicitly stated that traditional industrial markets like bulk chemicals and steel manufacturing are currently suffering from massive overcapacity on a global scale.
So there's no growth there.
Right. Any new industrial gas contracts in those sectors are largely just replacing old, end-of-life assets, not capturing new net growth. But the electronics sector is where the actual structural geopolitical growth is happening. Because Air Products aggressively maintain their operational capability and their local presence in Asia, they are perfectly positioned to capture the infrastructure layer of that supercycle.
It is a textbook example of a management team recognizing a stagnant market in one sector and ruthlessly reallocating their capital to the highest return opportunities in another.
Capital discipline at its finest.
But we cannot talk about their project portfolio without zeroing in on the absolute granddaddy of them all. We talked about the green energy projects they canceled. Now we have to talk about the massive green energy project they kept.
Oh yes, and NEO.
The NEO green hydrogen project in Saudi Arabia, often referred to in the transcript as NGHC. This is slated to be the world's first massive commercial-scale green ammonia plant, and they just announced a highly complex, multi-layered agreement regarding its output.
Yes. Management announced they have finalized a long-term marketing and distribution agreement with IARA for the renewable ammonia produced at the NEOM facility.
Okay, we need to completely deconstruct the mechanics of this arrangement because it is deeply complex and carries massive implications for the long-term balance sheet. First, let's establish the baseline. Air Products is a partner in the NEOM joint venture. As part of that partnership, Air Products is contractually obligated to be the sole off-taker, meaning they have to buy 100% of the green ammonia produced by the plant.
Every single drop.
Right. But Air Products is an industrial gas company. They are not a global maritime shipping company, and they are not an agricultural fertilizer distributor, so they partnered with IARA.
That is the structural setup. Under this new agreement, IARA which possesses a massive global shipping fleet and established agricultural distribution networks, will physically transport and commercialize the renewable ammonia that Air Products is obligated to buy from the joint venture.
Okay, so IARA handles the logistics.
Specifically, IARA will handle all the volume that Air Products does not intend to use for its own internal operations in Europe.
I have to challenge the immediate relevance of this deal, though, based on a specific quote from the transcript.
Let's hear it.
Management spent a significant portion of this call touting the brilliance of this IARA partnership. But then, almost in passing, Menezes explicitly said, "We do not expect this project to have a material financial impact in fiscal year 2027.
Yeah, that was a head scratcher.
If you are an investor, you have watched this company pour billions of dollars into building this sci-fi level mega project in the Saudi desert for years, and they are now telling you there will be zero financial impact next year. No massive revenue bump on the income statement, no massive cash flow generation. How is that mechanically possible?"
You aren't the only one who caught that. Several analysts pressed management incredibly hard on this exact timeline discrepancy during the Q&A.
And what did they say?
The answer lies in the engineering reality of what they were actually building. The Ineum facility is not just a standard chemical plant, it is an entirely first-of-its-kind integration of massive, disparate technologies.
Let's break down that mechanism. What actually happens at Ineum?
First, they are generating massive amounts of renewable power through dedicated solar and wind farms. They route that intermittent electricity into massive electrolyzers, which split purified water molecules into raw hydrogen and oxygen.
Okay, so that is the green hydrogen phase.
Exactly. But you cannot easily put raw hydrogen onto a ship. It requires insanely cold temperatures to liquefy and is notoriously difficult to transport.
It's just too volatile.
Right. So they take that green hydrogen and they feed it into a massive chemical loop alongside nitrogen harvested from the air. Using a highly energy-intensive mechanism known as the Haber-Bosch process, they synthesize the hydrogen and nitrogen into ammonia.
And ammonia is easier to ship.
Much easier. Ammonia is a liquid at much more manageable temperatures, making it physically viable to pump into massive tanker ships and export globally.
So they are essentially using ammonia as a chemical battery to transport renewable solar and wind energy from the Saudi desert to global markets.
Yeah, exactly. But because they are integrating renewable power generation, water electrolysis, air separation, and chemical synthesis on a scale that has literally never been attempted before, they are factoring in a massive, prolonged commissioning phase.
Like a testing phase.
Yeah. When you turn on a plant of this complexity, you do not just flip a switch and run at 100% capacity on day one. You test the electrolyzers, you bounce the chemical loops, you calibrate the pressure valves. It takes months, potentially quarters, to ramp a facility this magnitude up to full, stable commercial production.
Oh, I see.
Therefore, from a purely financial perspective, management is warning investors that the cash flow impact to Air Products in fiscal 2027 will essentially be zero, while the engineers finalize the physical reality of the plant.
Okay, that makes engineering sense. But let's look past the 2027 commissioning phase. Let's assume the plant is fully operational and running at 100% capacity. What does this IARA agreement actually do for the financial risk profile of Air Products? Does it insulate them?
This is where we have to separate the risk into two distinct categories: volume risk and price risk. The CEO clarified that the IARA agreement is designed to completely eliminate the volume risk.
And volume risk in the ammonia business is an existential threat. Ammonia is a highly toxic physical chemical product that requires specialized cryogenic or pressurized storage tanks. You cannot simply vent excess ammonia into the atmosphere if you produce too much of it.
No, absolutely not.
If your storage tanks are full and you don't have a ship waiting at the port to take it away, you physically cannot produce anymore. You would be forced to completely shut down a multi-billion-dollar continuous process chemical plant, which is an engineering and financial disaster.
Precisely. By signing this agreement, IARA takes on the logistical burden. IARA has the specialized ships, the global distribution network, and the established customer base in the agricultural and chemical sectors to physically move every single ton of product as soon as it is produced.
Air Products never has to worry about a storage bottleneck forcing a plant shutdown. The physical volume risk is entirely mitigated. But what about the price risk?
And that is the massive lingering catch. Air Products still retains the ultimate price risk. As part of their founding agreement with the Ineum joint venture, Air Products is legally committed to a 30-year fixed-price off-take agreement.
Wait, meaning they are contractually, legally obligated to buy this green ammonia at a predetermined fixed cost every single day for the next 3 decades?
Yes. They buy it at a fixed cost, but they are relying on IARA to sell it into a global commodity market where the price fluctuates wildly based on supply, demand, and the price of traditional fossil fuels.
So the entire financial viability of this multi-billion-dollar bet hinges on the assumption that global buyers, whether they are shipping companies looking for clean fuel or European fertilizer companies trying to meet emissions mandates, will be willing to pay a massive green premium for renewable ammonia over the next 30 years to cover Air Products' fixed cost base.
That is the exact mechanism of the gamble. They solve the logistical volume problem, but the long-term price problem is entirely dependent on the trajectory of a global energy transition that is currently proving to be incredibly unpredictable.
I want to keep that 30-year risk in the back of our minds, but I want to look at how they are handling the immediate fallout of the projects they did cancel. Specifically, the Louisiana project, known as Darrow.
The big one.
Yeah, this was a major component of that $2.9 billion write-off. Now, my initial assumption when a heavy industrial project is canceled is that the company basically fires the contractors, abandons the muddy construction site, and attempts to sell whatever steel they left behind for scrap metal. But based on the transcript, that is not the mechanism of this cancellation at all.
Not at all, because the Darrow project was not just a concept on paper. It was heavily into the procurement phase.
They already bought stuff.
Oh yeah, they had been engineering and designing this facility for years. And more importantly, they had already deployed massive amounts of capital to purchase the core top-tier industrial equipment required to run it. We are talking about massive custom-built air separation plants, highly complex hydrogen purification units, and a massive ammonia synthesis loop.
Wow!
This equipment isn't conceptual. It is physically sitting in warehouses and fabrication yards across the US, Europe, and China right now.
So they aren't just taking the write-off and walking away. They are actively trying to salvage the physical capital.
Exactly. Management confirmed they have tasked a dedicated internal team of engineers and business development executives with the sole mandate of figuring out how to redeploy or monetize this massive stockpile of capital equipment.
Let's break down the redeployment mechanism. How do you repurpose half a plant?
Take the air separation units, the ASUs, for example. An ASU is a massive cryogenic distillation column that takes atmospheric air, cools it down until it turns into a liquid, and then separates it into pure nitrogen, oxygen, and argon based on their different boiling points.
Right, which we talked about for the semiconductor plants.
Yes. Air Products builds ASUs all over the world for their traditional electronics and refining customers. So instead of buying new ASUs for their growing Asian electronics backlog, they can simply take the ASUs they already built for the canceled Darrow project, ship them to Taiwan or Korea, and integrate them into their highly profitable traditional gas projects.
Oh, that makes perfect sense for the air separation equipment because it's their core competency. But what about the ammonia loop? Management specifically noted they have a 4,000 tons per day ammonia loop sitting in storage. That sounds like a highly specialized piece of equipment specifically designed for a mega project. How do you liquidate something that massive?
It is highly specialized, but it is also incredibly valuable in the current market. A 4,000 ton per day ammonia loop is a massive, fully integrated chemical processing unit.
Right.
Menezes pointed out to the analysts that if you look at recent market transactions in the chemical sector, there's a massive global demand for prefabricated complete ammonia assets. Because they already did the years of engineering, design, and procurement, they possess a fully realized asset that another chemical company might desperately want.
So they intend to sell it on the secondary market as a fully integrated turnkey unit, rather than chopping it up and selling it piecemeal to maximize the recovery value.
Precisely. Which means that while the $2.9 billion charge is the harsh accounting reality on the balance sheet today, over the next 12 to 24 months, they might actually claw a significant portion of that back in hard cash by selling off these highly desirable assets to other players in the industrial sector.
And if you are modeling this company, any cash they generate from the sale of that ammonia loop would be categorized as non-GAAP income that simply flows right back into their general capital allocation pool, strengthening their balance sheet even further.
Exactly. It provides an unexpected infusion of cash precisely as they're transitioning back to their core traditional business.
Which brings us perfectly to the final section of our deep dive, Section 4, the bottom line. We've deconstructed the GAAP versus non-GAAP paradox. We've explored the pass-through contracts, shielding them in Europe. We've analyzed the salt cavern that saved them from the helium crisis. And we've mapped out the pivot toward the semiconductor supercycle. So based on the totality of this transcript, what is the final verdict on the stock?
If we synthesize all of the mechanisms we just discussed taking in both the undeniable strength of the underlying core operations and the chaotic reality of a massive strategic shift, the definitive signal here is cautiously bullish for the retail investor.
Cautiously bullish. I want you to defend that position. Because I guarantee there are investors listening right now who see a management team that just admitted they wasted nearly $3 billion of shareholder capital, and those investors are heading for the exits. Why should they stay?
The reaction to flee is entirely understandable on a surface level. A $2.9 billion write-off is a bitter pill. But you have to look at the mechanism of management's decision-making process here. This cancellation demonstrates absolutely ruthless capital discipline.
They refuse to fall victim to the sunk cost fallacy.
Exactly. It takes a massive amount of corporate fortitude to look at the shifting macroeconomic landscape, realize that inflation and interest rates have turned your visionary green energy project into a losing hand, and publicly take the humiliating write-off to stop the bleeding.
It does take guts.
It does. But the bullish thesis isn't just that they stop the bleeding. It's what they are doing with the saved capital. They are taking the billions they would have spent finishing those green projects, and they are immediately reallocating it to the highest margin, highest demand areas where they possess an unassailable competitive advantage.
They are leaning heavily into the semiconductor supercycle in Asia, and they are maximizing the efficiency of their high-performing U.S. refinery assets.
Yes. So the core cash-generating business is highly efficient, the margins are actively expanding, and management had successfully cleared away the riskiest, most capital-intensive distractions from their long-term portfolio. Structurally, that is a highly bullish setup for the next 5 years.
Okay, let's translate that bullish setup into actionable advice. If a listener is currently holding APD, or considering initiating a position after this massive pivot, what are the top 3 concrete takeaways they need to monitor moving forward?
Number 1, watch the macroeconomic environment. Air Products is a massive global bellwether. Their financial health is deeply tied to global industrial output. Management was explicitly cautious about the macroeconomic reality during the call. They reiterated that Europe currently possesses absolutely zero industrial growth, and the Chinese domestic market is actively grappling with severe overcapacity in traditional manufacturing.
So the thesis is that their current growth is surgically isolated to specific high-tech sectors like electronics and specialized on-site assets, rather than broad global GDP expansion.
Exactly. If the global macro picture degrades further, and a severe recession hits the electronics sector, even their highly defensive pass-through contracts and operational efficiency could face severe top-line headwinds.
That is a critical risk factor. What is actionable takeaway number 2?
Number 2, focus on the capital returns. Despite the massive headline noise of the write-offs and the strategic pivot, the underlying base business remains an absolute cash-generating juggernaut. Management highlighted that they have already returned $1.2 billion in cash dividends directly to shareholders this year alone. They are highly committed to protecting and growing that dividend.
The mechanics of that are staggering. The ability to fund a $1.2 billion dividend payout while simultaneously taking a $3 billion accounting charge and fundamentally pivoting the entire capital allocation strategy of the company is a massive testament to the sheer strength of their underlying operating cash flow. And what is actionable takeaway number 3?
Number 3 is a major impending catalyst that every investor needs to keep on their radar. During the financial breakdown, the CFO explicitly noted that the company's net debt to EBITDA ratio is currently sitting at a highly manageable 2.1x.
Let's quickly define that mechanism. EBITDA is earnings before interest, taxes, depreciation, and amortization. It is a proxy for the raw cash the business generates from operations.
Yep, the cash engine.
So a 2.1x ratio means their total net debt is only about twice the size of the cash they generate in a single year. For a massive industrial company that builds multi-billion-dollar physical infrastructure, carrying debt at only 2 times earnings is incredibly conservative.
It is a fortress balance sheet. And here is the catalyst. Because their debt is so low, and because they are actively slashing their future capex by canceling these mega projects, they're about to start generating massive amounts of unallocated free cash flow.
Oh, wow. What are they going to do with it?
Well, Schaefer provided a direct line of sight to the market. indicating that they expect to be in a position to initiate a massive share buyback program toward the end of fiscal 2027 or early 2028.
And the mechanism of a share buyback program provides a massive structural floor for the stock price. If the market knows that the company itself is preparing to step in and utilize billions in free cash flow to buy up millions of their own shares on the open market in 12 to 18 months, it heavily discourages short sellers. And it provides a very compelling reason for long-term investors to hold the stock through the current messy transition period.
It absolutely is. A buyback program of that scale is the ultimate financial signal of a management team's confidence in their own localized cash generation capabilities.
So, synthesizing everything. We have a company that is taking its painful medicine today by clearing out the green energy dead weight. They are leaning aggressively into the hottest sector of the global economy by supplying the semiconductor supercycle. They are utilizing strategic geological assets to dominate supply chain chaos, and they are preparing to shower their shareholders with a tidal wave of free cash flow in the near future.
That's the bull case.
It is a highly compelling operational narrative, provided you can stomach the messy accounting of the transition.
It is a compelling narrative, but there is one piece of the puzzle, one specific mechanism we discussed today that still has me questioning the long-term horizon.
And that brings us to our final lingering thought, the ultimate question we want to leave you, the listener, to mull over and research on your own. We spent a significant amount of time breaking down the massive NEOM green ammonia project and the intricate deal they struck with IARA.
Right. We established that management executed a brilliant logistical maneuver by partnering with IARA to handle the physical volume of the green ammonia. They successfully eliminated the existential engineering risk of their storage tanks overflowing in the Saudi desert.
Right.
But the mechanical catch remains. Air Products explicitly retain the price risk. They're locked into a 30-year fixed cost obligation to purchase that ammonia.
So here is the provocative thought for you to explore as an investor. What happens to the balance sheet of Air Products if the global market ultimately decides it simply isn't willing to pay a massive green premium for renewable ammonia?
It's a huge unknown.
What if traditional fossil fuel-derived ammonia created cheaply with natural gas remains drastically cheaper for the next 3 decades, and global agricultural buyers simply choose the cheaper, dirtier option to protect their own margins?
Yeah.
Could this 30-year fixed-cost offtake obligation, which management is touting today as a visionary anchor for the future, slowly morph into the exact same kind of crippling financial deadweight that they just spent $2.9 billion trying to escape?
It is the ultimate multi-billion-dollar question. They completely solved the physical volume problem, but the ultimate profitability of the NEOM project is entirely dependent on a global energy transition that is proving to be highly nonlinear, deeply political, and incredibly unpredictable.
And navigating that exact kind of unpredictability is exactly why we do this. We started this deep dive by talking about how an earnings report is rarely a clean, straight-A report card.
Usually not.
Sometimes you really do have to total the family car, clear the wreckage, and figure out how to build a completely new engine to navigate a fundamentally altered highway.
But if you know how to read the actual structural signals and you take the time to understand the underlying physical mechanisms driving the business, you can accurately identify the massive value hidden just beneath the accounting wreckage.
Well said. Thank you for joining us on this deep dive. You are now armed with the real story, the full operational context, and the actionable structural signals hidden within the Air Products Q3 2026 earnings print. Keep looking past the headline numbers, keep questioning the mechanics of the narrative, and we will see you next time.